Gold dropped to $4,583, then recovered to $5,016. Same week, same market, same war. Two completely different gold prices separated by days. That kind of range, from 4,583 to 5,016 in a single week, does not happen in a healthy market. That is not normal price discovery. That is a market that has lost its internal compass and is swinging between two completely different assessments of what gold is worth and why. And sitting right in the middle of that swing is one of the most significant shifts in Federal Reserve expectations in recent memory. Every single Fed rate cut that was priced into 2026 is now gone. Not delayed, not reduced, gone. And in its place, traders are now pricing the possibility of a rate hike. After years of rate cut bets, the market has flipped completely to the other side of the table. That is the real story this week, not the gold price swing $400. The reason it swung $400. And the reason is something that most investors have not fully absorbed yet because it happened quickly and the financial press covered the symptoms without explaining the cause. Stay with me, because the sequence of events that produced this week's market behavior tells you something important about where we are in this cycle. And it starts not with the Fed. It starts with a 2022 playbook that just got pulled off the shelf. Investors this week started drawing parallels to 2022, specifically to the options market strategies that were deployed in 2022 when the Fed began its most aggressive rate hiking cycle in decades. If you remember 2022, you remember what it felt like. Equity markets falling, bond markets falling simultaneously, the traditional portfolio balance between stocks and bonds breaking down because both were moving in the same direction at the same time, volatility spiking, correlations across asset classes rising toward one, meaning everything moved together and diversification stopped working. That environment, everything correlated, everything volatile, the traditional rules breaking, is what 2022 is shorthand for in the investment community. It was a year that tested portfolios built on assumptions that did not hold, and it produced significant losses for investors who had not prepared for the specific combination of rising rates plus falling growth plus persistent inflation. The options market is now reverting to that playbook. Investors are positioning for a return of that environment. The same strategies that protected portfolios in 2022 are being dusted off and deployed again. Why now? What happened this week that made investors reach back to 2022 as their reference point? The answer is in the bond market. And the bond market answer leads directly to the Fed. And the Fed answer leads directly to gold's $400 weekly swing. Here's the question worth holding as we go deeper. In 2022, the Fed was raising rates aggressively. It was doing so because inflation was high and it needed to cool the economy. The playbook that investors used in 2022 was built around the assumption that the Fed would keep tightening until something broke. That assumption eventually proved correct. Something did break, and the Fed eventually pivoted. The question for right now is whether the same sequence is about to replay. The Iran war has created an inflation shock through oil prices that the Fed cannot address by raising rates, because the inflation is supply-driven, not demand-driven. And yet, the market is pricing a rate hike anyway, because the Fed feels pressure to respond to rising prices even when the tool it is using cannot fix the underlying problem. If the Fed hikes into a supply shock inflation environment, what breaks this time? And when it breaks, what does gold do? We will come back to that. First, we need to understand exactly what happened in the bond market this week, because the bond market move is the most technically significant development in this entire story. Short maturity Treasury yields are soaring. No further Fed easing is priced for 2026. That is the baseline as of this week. The phrase bond trader scramble is not commentary, it is description. What happened in the bond market this week was a rapid and disorderly repricing of Fed expectations. Traders who had been positioned for rate cuts, who had built positions in short maturity bonds specifically because they expected yields to fall as the Fed cut, were forced to exit those positions quickly as the data and the Fed language forced a reassessment. When bond traders exit positions quickly, they sell bonds. When they sell bonds, prices fall. When bond prices fall, yields rise. And when yields rise across the short end of the curve, the most rate-sensitive part, it sends a very specific signal to every other asset class. The signal is, the Fed is not coming to help you. That signal hit gold at $4,583, the low of the week. The point at which the forced selling from leveraged positions, combined with the surging yields and the dollar strength that follows rising yields, pushed gold to its lowest level in recent weeks. The sell-off exceeded typical reactions. That phrase, from the FX Street coverage, is the most analytically significant characterization of the week. Exceeded typical reactions means the move was larger than the underlying data alone would justify. It means something additional was operating, and that something additional is the same thing we identified in last week's analysis. Forced selling from leveraged positions, margin calls, liquidation that happens regardless of whether the seller wants to sell. Gold at 4,583 was not the market's calm, considered assessment of gold's fair value in the current environment. It was the market's panicked, forced assessment produced under financial stress. And those two types of price formation produce very different outcomes when the stress passes. Fed officials this week said something that central bankers almost never say publicly. They said the Iran war is obscuring the economic outlook. Think about what that admission means. The Federal Reserve, an institution that is built on the premise that it can model the economy, forecast conditions, and set policy accordingly, is publicly acknowledging that it cannot see clearly right now. The war has introduced a variable so large and so unpredictable that the standard forecasting models are not producing reliable outputs. That is an extraordinary admission, and it has direct implications for how markets should price Fed behavior going forward. When the Fed can see clearly, markets can price its behavior with reasonable confidence. When the Fed itself admits it cannot see clearly, that confidence breaks down. And when confidence in the Fed's predictability breaks down, risk assets face additional pressure because one of the key anchors of market stability, knowable Fed behavior, is no longer knowable. The market's response to this uncertainty was to price the most conservative possible Fed outcome. If the Fed cannot see clearly, and if the data it can see is showing oil-driven inflation that exceeds its targets, then the safest assumption is that the Fed tightens rather than eases, hence the rate hike pricing. Not because a hike is certain, but because it is the tail risk that markets feel compelled to hedge against when the central bank's own language has introduced maximum uncertainty. Here is where it gets genuinely complicated. And this is the part most analysis is glossing over. Gold at $5,016, the recovery level, is trading at a price that reflects safe haven demand from the war. The geopolitical premium is still embedded in that number. Gold without the war premium would be lower. But gold at $5,016 is also trading in an environment where yields are soaring and where a rate hike is being priced. Those two forces, war premium pushing up and yield pressure pushing down, are currently in rough equilibrium at $5,016. The question is, what happens to that equilibrium when one of the forces changes? If the war de-escalates and the safe haven premium comes out, gold faces the yield pressure without the war premium to offset it. That scenario points to significantly lower gold. If the war escalates further and oil spikes higher, the inflation gets worse, the Fed tightens more, yields go higher, and the war premium, which requires the war to be a gold-positive event, faces the paradox we identified last week. The war that creates the safe haven demand is simultaneously creating the policy environment that acts against gold. Both scenarios lead somewhere uncomfortable for gold holders, and the current equilibrium at $5,016 is not a stable resting point. It is a tug of war between two forces that are both going to resolve in one direction or the other. Which direction and when? That is what nobody knows right now, including the Fed. Let's trace the exact sequence that produced this week's market behavior, because understanding the sequence is the only way to understand where we are in it. Oil prices surged because of the Iran war and the supply disruptions we have covered in previous videos. The LNG shutdown in Qatar, the Ras Tanura refinery strike, the Strait of Hormuz disruption, those physical supply chain disruptions pushed oil higher. Higher oil feeds directly into inflation through energy costs, transportation costs, and manufacturing costs. The inflation data began capturing those effects and printing above where the Fed had projected. Above target inflation with a hawkish Fed means the Fed cannot cut. It was already saying one cut for 2026 as of last week's dot plot. This week, with oil-driven inflation exceeding projections, the market moved beyond no cuts to pricing a hike. The hike pricing pushed short maturity yields soaring. No further Fed easing in 2026 is the new baseline priced into the curve. Soaring yields increase the opportunity cost of holding gold. Every basis point of yield increase on a Treasury bond makes gold, which pays nothing, comparatively less attractive at the margin. At the same time, rising yields attracted capital into the dollar. Stronger dollar means gold priced in dollars faces mechanical downward pressure as foreign buyers face higher effective prices. The combination of yield pressure and dollar strength drove gold to $4,583 on top of the leveraged position liquidation that amplified the move beyond typical reactions. Then the war safe haven demand reasserted itself and gold recovered to $5,016. That is the full transmission mechanism. Oil shock to inflation, to Fed, freeze to yield, surge to dollar strength to gold, drop to war premium recovery. 7 steps. Every one of them operating simultaneously this week, and every one of them still active as the week closes. Let's return to the 2022 comparison, because it is useful but also potentially misleading if taken too literally. In 2022, the Fed was raising rates into high inflation. The economy was running hot from post-COVID stimulus. The inflation was primarily demand-driven, too much money chasing too few goods. Rate hikes were the correct tool because they cool demand. The Fed raised rates aggressively, markets fell hard, and eventually the rate hikes worked and inflation came down. The current situation shares the surface features of 2022. High inflation, Fed tightening, falling markets. The 2022 playbook, buying protection against correlated equity and bond declines, makes surface sense. But there is a critical difference underneath the surface. The current inflation is not primarily demand-driven. It is supply-driven. Oil prices are high because refineries have been struck and shipping routes are disrupted, not because consumers are spending too much. Rate hikes do not fix a refinery that has been shut down by a drone strike. Rate hikes do not reopen the Strait of Hormuz. The Fed's tool is the wrong tool for this type of inflation. In 2022, tightening eventually worked because tightening was the right response to the type of inflation present. In the current environment, tightening may cool demand and slow growth, which would be a stagflation outcome. Without meaningfully reducing the supply-driven inflation it is ostensibly designed to address. That distinction is why the 2022 parallel is useful for positioning, but potentially misleading for predicting outcomes. The option strategies from 2022 may protect portfolios from the volatility, but the resolution, how this ends, may look very different from 2022 because the underlying cause is different. And this brings us to the most important unanswered question in the market right now. In 2022, the endgame was clear in retrospect. The Fed tightened, demand cooled, inflation came down. The Fed eventually pivoted toward cuts, and markets recovered. What is the endgame here? If the war resolves, if a ceasefire, a diplomatic framework, or a military conclusion returns oil supply to normal levels, then the supply shock inflation goes away. The Fed no longer needs to hike. The tightening cycle that is being priced right now never materializes. And gold, which has been squeezed between war premium and yield pressure, gets to keep the war premium without the yield headwind. That is a meaningful recovery scenario. If the war does not resolve, if oil supply disruptions persist or worsen, the Fed faces an impossible choice. Hike into a supply shock and risk crashing the economy without fixing the inflation, or hold and watch inflation expectations become unanchored while the dollar softens. Neither option is clean. Neither option is good for risk assets broadly. And in that second scenario, what does gold do? Gold, in a genuine stagflation environment, falling growth, persistent inflation, a Fed that is either wrong-footed or ineffective, has historically been one of the better performing assets precisely because it does not depend on economic growth and because it cannot be printed by any central bank. But getting to that scenario from where we are now requires navigating the yield pressure that is currently the dominant headwind. And that navigation is not painless. The $400 weekly swing in gold is the market trying to price both scenarios simultaneously. The 4,583 low is the yield pressure scenario. The 5,016 recovery is the war premium scenario. And the market cannot decide which one dominates because the outcome depends on a war that nobody can forecast with confidence. Kitco's characterization of gold as steady at 5,016.53, flat with futures up just 0.4%, is the most revealing data point in this week's coverage precisely because of how unremarkable it sounds. Gold holding steady sounds like nothing is happening. But gold holding steady at 5,016 after a drop to 4,583 in an environment of soaring yields, rate hike pricing, dollar strength, and market stress is actually a statement. It is the war premium fighting back against every headwind that should be sending gold lower. Geopolitical safe haven support offsets dollar pressure. That is the characterization from the Kitco coverage. Offsets, not overcomes. Offsets. The war premium is currently just large enough to keep gold from falling further under the yield and dollar pressure. But it is not large enough to produce new highs or meaningful gains. That equilibrium is fragile, and both sides of the offset can shift independently of each other. The dollar pressure can intensify if yields rise further. The safe haven support can weaken if the conflict moves toward resolution, or if investors decide that the war is now a headwind rather than a tailwind for gold. Flat gold in this environment is not a signal of stability. It is a signal of tension. Two forces of roughly equal magnitude pulling in opposite directions, and the flat line is where they meet, for now. The market erased every Fed cut bet for 2026 this week. Bond traders scrambled as oil-driven inflation flipped their positioning. The options market reached back to 2022 for its playbook. Gold swung $400 in a week and ended essentially flat, and the Fed itself admitted it cannot see clearly because the war is obscuring the economic outlook. That last sentence is the one worth sitting with as this week closes. The institution that sets the price of money in the world's largest economy, the institution whose decisions ripple through every asset class, every currency, every gold price, every bond yield, publicly stated this week that it does not have a clear view of what is happening or what to do about it. That is not a normal state of affairs. Central banks are supposed to project confidence and clarity even when they are uncertain. The public admission of obscured visibility is a signal about the severity of the uncertainty they are navigating. In that environment, markets do what they always do when the anchor institution loses visibility. They price the worst case, hence the rate hike bet, hence the 2022 playbook, hence the bond market scramble, hence gold's $400 weekly range. None of this resolves until the war resolves, or until the oil supply disruptions resolve, or until the inflation data gives the Fed enough clarity to communicate a coherent path forward. None of those resolutions are on a known timeline. What we know is that gold at 5,016 is a tug-of-war price, that the bond market has priced out all easing for 2026, that the options market is preparing for 2022-style volatility, and that the Fed has admitted it cannot see the road ahead. What we do not know is which force breaks first, whether the war premium holds, grows, or collapses, whether the Fed actually hikes, or whether the data eventually gives it room to hold, whether the 2022 parallel plays out to its conclusion or diverges, because the underlying inflation is a different animal than 2022's demand shock. Gold at 5,016 is the market's honest answer to all of those unknowns. It is not a confident answer, it is a confused one, and confused markets stay volatile until something clarifies the picture. The next clarity will come from wherever nobody is currently looking. That is almost always how it works.